afternoon. It's John Gillen at Stansberry Research. We're at our Alliance Conference in Las Vegas. It's my pleasure to welcome Seb Vaessen. Hopefully I didn't butcher that last name. He is a head of strategy at Naspers, a multinational internet and media group headquartered in South Africa in Cape Town, correct?
Correct.
And I would argue made one of the great investments in the history of investments by buying a huge position in Tencent. And we wanted to start with, by my math and by your talk today, stock's ridiculously cheap, a massive discount to the sum of the parts. Can you talk about that a bit, why that's taken place? And you mentioned you are obviously keen to change perception currently.
Absolutely. So let me start by saying we're a fairly sizable conglomerate in the sense that we have many different holdings in many different companies. So it's not unusual for a conglomerate like us to have a discount in the range of 15 to 20%.
Right.
But currently we see that our valuation market cap is at 100 billion. If you do a sum of the parts, it's we looked at the average across 16 analysts, it's at 160.
Right.
So that's a 40% discount, which also to us feels quite disproportionate. So, and you said we are also very keen as management, as shareholders, option holders, very keen to address this. What is driving this sizable discount? It's hard to put a finger on it, what's driving it exactly, but as far as we can tell, it's probably also to do with the fact that we are so big on the Joburg Stock Exchange. After 10 years of overperformance, we sort of we started as a relatively small newspaper company and are now the biggest internet company outside of the US and China. And it sort of resulted in a situation that we're now 25% of the total value of the Joburg Stock Exchange, which is great on one hand. On the other hand, it's creating a little bit of a problem because as Tencent continues to grow, that percentage becomes bigger and bigger. And we have local shareholders, local pension funds, that cannot invest more than X percent of their holdings in one business. Right. So every time Tencent grows, we have 4 sellers in the market. And we don't have enough international investors sort of picking it up. So that's why we're very keen to be here as well, to tell the story about Naspers, all the great things that we're doing, and also all the things that we're doing to address this discount.
Yeah, in my experience, where with this massive home run you've had with Tencent, and investors obviously only think in that regard, they are Tencent. But what they forget, yes, you're not a one-trick pony, and particularly the things you talked about today, these massive investments in food delivery you'd mentioned. And, folks, this is on sale. The China market's been difficult this year, of course, for a bunch of reasons, but that's simply historic volatility. It's nothing new, in my humble opinion, and particularly with the massive middle-class move that's taken place in China, which is a fact, and that's going to drive everything going forward in the opportunities. One question I did have, just back to valuation, was SoftBank. And SoftBank raising a $100 billion fund, which of course means that everybody wants into these opportunities that you all have been experts in for decades. Have they pulled forward valuations, in your opinion?
It certainly looks that way. We look at SoftBank, a renowned investor. They're actually very similar to Naspers in many ways. Yes. They also our conglomerate started out with, I think it was a software company of a CD-ROM software distributor. And made a fantastic investment in one of the Chinese gorillas, right? For them it was Alibaba. Yeah. For us it's Tencent. So in many ways we're alike. And we're very pleased by the fact that they also see the same opportunity that we see in online and the digital transformation that's going on around the world. We ourselves were a little bit less comfortable with the amount of money that they raised. We decided not to pursue the same path. We try to be more prudent investors and not to overpay too much. Like if you want to be in, sometimes you have to pay up a little bit just to get on the cap table. But we're not always as comfortable as apparently they are with some of the big bets that they made in the space.
You talked about emerging markets and growth opportunities there, and a lot of investors, myself included, can be myopic where we're concerned about a strong dollar, the massive debts that are in place. We're reading constantly about Italy these days and how they figure out how they're going to pay going forward. But a lot of this is borrowed in dollars, having to pay in their local currencies to cover their interest costs. That, again, that comes and goes. Has this put any of your favorite companies on sale? Do you see massive opportunities in India, Brazil, Africa? Or are things still expensive and you've...
Look, yes, there is a huge amount of debt, but we've been investors in emerging markets for a very long time, and there is a certain amount of risk that we are very comfortable with. That all being said, I don't perceive the valuations to be very low. Certainly not. There's still quite healthy valuations out there. Our businesses are certainly all not for sale at the moment. We actually see very big opportunities and in food delivery, in classifieds, and in online payments. And we actually intend to invest more rather than sell those businesses.
It's an incredible, I believe, opportunity, and I'm intent on writing a bunch about it, and it's a pleasure to spend some time with you, who's right in the middle of it, and again, with the greatest investment of all time.
Thank you.
Why not do it again? Great to see you. Pleasure.
Pleasure.
Thank you. If you're enjoying these videos, don't forget to press the like button. Comment down below, and if you're new here, please don't forget to subscribe, and remember to click that bell to be sure you don't miss out on our newest updates. And thanks a lot.